Nigeria will attain a 2% year-on-year growth in 2018. This will be strongly supported by continued stability in the oil sector due to stable oil production and high prices. This growth is, however, not adequate in the light of population growth. We envisage that population growth is at about 3%. So by 2050, our population should be just shy of 400 million people. So at population growth of 3%, GDP growth of 2%, for you to obtain at least sustainable growth, you should be twice the population growth. So we should be thinking of about 6% growth. The Economic Recovery and Growth Plan of the federal government aimed at strengthening the economic diversification by focusing on three broad objectives: restoring sustainable growth, building a globally competitive economy, and investing in human capital development has been largely applauded. In our PwC periodic quarterly bulletin of April 2017, we expressed the view that whilst the objectives of the ERGP are laudable, its vulnerability to political disruptions is a key risk which impacts the sustainability and enforceability of the development plan. In this publication, we noted that Nigeria could limit the impact of political disruptions through the institutionalization of its development plans. Specifically, there is a need to accelerate the enactment of the existing Development Planning and Project Continuity Bill, an offshoot of Vision 2020, which was initiated in 2011, to insulate present and future plans from political uncertainties. The ERGP identifies the need for huge investments in order to achieve sustainable growth. The plan intends to leverage private sector participation through the creation of an enabling policy and business environment to attract private sector finance targeted at infrastructure. This plan reckons that there is an investment of $3 trillion for infrastructure development over 30 years. That means $400 billion over the period of the plan 2017 to 2020. Let's look at this against the backdrop of the fact that traditional sources of financing are stretched. Massive amounts of private investments will be required, certainly, to bridge this gap. We have situations where we are shy of GDP investment numbers. When we talk about China and India compared to Nigeria, you'll see it in the main presentation that I'm sure will be shared. I don't want to bore you with those details and the detailed slides that will show those information. But it's clear, therefore, that Nigeria would necessarily and aggressively need to boost domestic and foreign investments over the next decade. The question is, where do we get the investment to stimulate the ideal growth for economic sustainability? We know federal government or federal sources are limited. We are currently stretched. 31% or 32% thereabout forms the basis for capital investment as a proportion to total budget in 2017 and 2018. We know that continuous investments or attempts to borrow will be limited. We must expand our tax base. 6% is embarrassing, to put the least. And let's put it in context. That 6% is even as high because most of it is attributed to oil-related taxes. There are ongoing reforms, quite all right, but initiatives like VAT to increase tax compliance must be sustained. it is important that we sustain efforts in tax compliance, collections, and adopting technology as an enabler. More so, getting the informed sector into the tax net is also very crucial. I did a search recently with the Lagos State Inland Revenue and found out that probably in Nigeria, one of the top 50 personal income taxpayers. Don't assume I'm one of the richest. It's clearly not along those lines. It just shows the level of our compliance. Clearly, most people are not complying relative to income. Secondly, there is a need for us to free up the exchange rate structure which allows for a wider autonomous interbank market, thus providing a more liquid market for price recovery. This has happened in Egypt. The result is that there has been excellent, massive increase in foreign investments. The last key issue is the subsidy. Oil subsidy. This is clearly a subsidy for the rich and upper middle class, and much of the over 1 trillion naira subsidy is diverted or used for fuel in other countries. If we end this, we'll free up enough funds for infrastructure, education, and reducing our deficits. However, with the best of reforms, with these 3 suggestions, there's still going to be a significant gap. Private sector needs to come in to fill this gap. It's on this basis that the role of the private sector, especially the importance of the capital markets in mobilizing the resources Nigeria needs for economic development, cannot be overemphasized. A robust capital market is crucial for attaining economic growth and development objectives. This is because it provides access to capital necessary for financing economic activities, both private and public sector. The implication of a robust capital market is an increase in productivity within the economy, which leads to more employment, increase in aggregate consumption, and hence growth and development. This also helps in diffusing stresses on the banking system by matching long-term investments with long-term capital. I think 1 or 2 of our professional colleagues came up very briefly to re-emphasize the importance of we as an institute in terms of making or contributing to the development agenda. Without prejudice to the recent positive comments said about the performance of our stock exchange, experts, however, argue that Nigeria's capital market remains severely underdeveloped at about 11% GDP, significantly below the world average of about 98% in 2016. Developing the capital market requires both demand and supply improvements, which involves the creation of investable assets and securing a large universe of stable domestic and foreign investors that want to buy Nigerian assets. There is certainly offshore interest for Naira assets, as evidenced by reduction in yields in the bond markets and the rebound in the stock markets, which both attracted foreign private investments of about $6.8 billion as at Q2 of 1917 and 3.5 by 2016. However, there are investors who are also comfortable with Nigeria risk, but not necessarily with the Naira risk. And by issuing external bonds, Nigeria attracts this class of investors, further increasing investor confidence and expanding Nigeria's investment base. However, we are faced with significant challenges which impede market development. 2 prominent ones from an outsider's perspective are trust and liquidity. Let me briefly switch gears and highlight some of these. The Nigerian capital market has been unable to make its expected contributions as it's faced with these challenges. Trust. Poor legal framework, non-compliance and transparency issues as perceived deters investments from both local and international investors. Liquidity. Stock turnover is at about 7.5 compared to 30.7 in Egypt and 25.7 in South Africa. Only few entities are regularly traded among securities listed on the market. The depth of the market, equity capital remains most active, while the bond and derivative market is ahead of most African peers. There is still room for improvement. Inadequate long-term savings, and lastly, high transaction costs. High flotation costs, stock exchange costs, etc., main board listing cost about 0.3% in terms of market capitalization compared to 0.04% of what it is with the South African exchange. So clearly, in order to play a major role in anchoring flow of funds for development, the Nigerian capital market needs to overcome these challenges. In another PwC publication, we gave 6 priorities for capital markets looking forward into 2020. The first of these is to proactively manage risks, regulations, and capital. Regulatory response must be proactive and increasingly integrated into business as usual practice. Risk and capital should be managed holistically throughout the enterprise and with an end-to-end analytical rigor to succeed in a complex and dynamic ecosystem. Establish stronger culture and conduct. To respond to market criticisms, participants must change for good and embrace a culture of transformation that fosters transparency and high professional standards while minimizing conflicts of interest. These changes will increasingly become key value drivers and differentiators of the future as society assesses the social utility of capital markets and its participants. Third, we must redefine the business model. A shift in business models enabled by technology is occurring. Financial institutions will look to rationalize their offerings, country footprints, and the clients they serve on the way to building simpler business models. Strategically renew operating models. IT automation, consolidation, and utilization of middle office and back office activities will simplify operating models, reduce costs, and improve profitability. 5, enable innovation and capacity to foster it. Innovation will need to come to the forefront to drive excellence and to fill profitable gaps. Much of this innovation will come in the area of risk, capital, and collateral management, as opposed to the product level, which has been the historical source of innovation in capital markets. And lastly, we need an information advantage. By harnessing the power of big data, leaders will be able to create competitive advantages in client experience, operational design, risk management, and profitability.